Good afternoon. Welcome to this live broadcast here on BloombergQuint. It's a complete decimation of the markets, particularly led by the banks. Across the board, banks taking a knock in the session, Neeraj. And the key culprits being all those bellwether names that everyone stood by in good times.
Yeah, I think that's the problem, isn't it, Devina? We can understand if a few banks are falling down, but the marquee names are standing put. But look at this chart. Look at this data point, essentially. This is the MRR function of the Bloomberg terminal, which shows you the intraday moves. Yes Bank being 4% is an outlier. Look at the losses that have happened to an IndusInd Bank, to an Axis Bank, to a Kotak Bank. The point that I think Devina was trying to make, that even if you ignore that there are some issues that rumors surrounding certain banks, and therefore they are falling, the likes of IndusInd Bank, which is, by the way, the highest fall that it's had in its life. The kind of falls that Kotak Bank, which is down 9%, HDFC Bank, which is down 6%, are showing, and ICICI Bank, after the 9% fall yesterday, falling another 3%, speaks about the volumes of decimation. And I think the point that I was trying to make, this is the Kotak Bank history and the statistic today. It has fallen the most since March 30th, 2009, when it was down about 10.6%. We are not done yet with
this
the
is the closing basis, yes.
The closing basis, we are not done yet. What if this worsens? Because the world markets too are not looking all that pretty.
Yep, and in fact, who better to talk to us about all of this than Ajay Bagga, who's always been with us to give us a very frank commentary on the markets. Ajay, what have you made out of this route that we are in right now? There's clearly no bottom in place. A global investor are in a selling frenzy. We've seen the ETF money moving out at an extremely fast pace.
Absolutely, Devina. Overall, it has been quite surprising, the kind of cuts that we have seen on the markets. And markets are discounting in second-order troubles. Last night, the U.S. tourism body put out a report that they are expecting a 6 times fall in tourism and transport revenues, 6 times of what they saw in September 11. After the U.S. terrorist attack. So that's the kind of dislocation that is happening for corporates. They have said that they are expecting about 4.6 million people to lose their jobs in the U.S. transport tourism industry over the next 6 months. This is just one sector, but the markets are really spooked by figures like that the second-order effects of the virus dislocation in terms of GDP degrowth, in terms of corporate earnings falling off a cliff, and a very high rise in credit costs, in credit defaults, both by corporates as well as individuals. That's why we have seen banks have fallen the most globally, followed by energy, which is linked to the oil prices, cratering by nearly 40%. And then we have seen all sectors getting hammered. But the big risks are these: lower GDP, lower corporate earnings, high credit defaults. These are the big looming issues that the markets are grappling with.
So for India in particular, Ajay, what's amplifying this selling that we're seeing? Obviously, now we have the weightage of about 9.2% on the MSCI. You have seen foreign investors pulling the plug and pulling out money with India. But has it got to do more with also the fact that there is illiquidity in some of the other emerging markets from where they're unable to pull out money, and therefore reduction of Asia exposure can happen through the Indian equity markets, and therefore the outflow of money at this space?
Absolutely, spot on. That has been an issue with us. In 1998, it was different. Post the Asia crisis, people realized Indian market is very illiquid. But 2008, we were able to give a lot of liquidity to global investors. And Devina, what's really happening? 3 things are happening. One is we have VAR models, value at risk. Moment those value at risk triggers come in, you have to just sell. And that's the model. When I used to work for foreign companies, we would just get the system has said it, the risk manager will take over your terminal, and you have to sell at any cost. Unlike when I used to work for an Indian fund manager, my fund managers, what they would do, my equity guy would disguise his order, will take the whole day to get out of a position so that the impact cost is less. Unlike that, what I've seen firsthand working in foreign asset managers, you would get, Frankfurt or New York will decide that this position has to be cut, everything must go. So the VAR issues are hitting globally, and we are seeing that in India also. The kind of decimation to, relatively good names, the kind of decimation that's happening, it's because of that. Second huge thing is that when VAR models are triggered, you are selling all asset classes. So we have seen from bond ETFs seeing outflows to gold to silver. Silver is more correlated to the economy because it's got industrial use as well as the luxury use. So silver you could justify, but gold falling so sharply was more clearly margin calls being funded out of gold and VAR models taking over. So it's an algo world where 80% of trading is done by algorithms, by computer models. Those software engineers have modeled all portfolios to behave similarly, and we are getting convergent selling, Neeraj.
Mr. Bagga, good afternoon. And the other question then therefore is, you've seen 2 or 3 such cycles. In the midst of the cycle looks like the worst that you've ever seen. A lot of people are saying that this is worse than any that they have seen, and comparing it to the 1929 periods as well. That conversation has started happening. My question is, do you, in your wisdom, foresee it to be that bad, or is it difficult to foresee? And therefore, are prices baking in the worst, or can it get worse before it gets better from here?
Yeah, very good questions, and those are all trillion-dollar questions because $1 million don't matter anymore, Neeraj. But I would say, one, nobody knows. Second, the most informed people like Howard Marks is saying we are probably 60% done in terms of the selling, 40% more to go. I would go with those, forecasters. Third, how much worse will it get? In terms of the VIX, the volatility indices, we have reached lifetime highs, and then the volatility came down a bit. So clearly, and we have not seen implied vols like this on options ever. 150, 180 kind of vols are happening. That kind of thing just, it shows the market can go down or up 10%, and that's what we are seeing. Who would have imagined U.S. markets showing 10% moves in a day? So clearly very high volatility, markets in grip of computers. We saw this program trading behind the 87 crash. Now the grandchildren of program trading, the algos have taken over. And, that kind of mayhem, then the regulators have to step in with shorter circuits, cooling off periods, maybe suspension of trading for some time so that people get some chance. How much more to go, Neeraj? Very tough to call. Should you put in money now? I don't think so. I think
you are saying that if, Ajay Bagga, you were sitting on 10-15% of your portfolio in cash, you're not tempted to put in even 5-10%. And it's okay to say no. I'm just asking.
Yes, I'm not tempted. And I'll give you the reason also. Normally I'm not afraid, and I love the markets. I made my fortune from the markets. So I know they will come back. But the kind of carnage that's happening, Neeraj, and the unknowns, the Fed has put in so much more. Apart from just rate cuts, they have put $1.5 trillion into the repo market. Last night they said we will stand by the commercial paper. You look at all the big ETFs which are on the high yield bonds, which is mostly the junk bonds. Those are really suffering. 1 or 2 major ETFs have seen AUMs come down to 25%, Neeraj. 75% kind of redemptions are happening. It's a very huge market in terms of the junk bonds, and those companies will not be able to refinance at the levels at which their bonds are now trading, 9%, 10% in dollar terms. So right now I'm saying there's a huge central bank stimulus on. Trump has talked of $950 billion of fiscal stimulus, putting $1,000 into every American's accounts. That's very good. That will help stop this carnage. Let all that happen. The virus is a smaller issue, I would say. We know how to contain it. Countries are taking very drastic measures that will help in containing the virus. Fallout will probably take 6 months. Markets were not cheap. Markets were quite leveraged. And we are seeing that second-order impacts coming. So first shoe to fall will be corporate earnings. Then the GDP is going down, followed by, the recovery path will be slow. So I think we have a runway of 3 to 6 months to make up our minds on investments, Neeraj. I think invest over that time rather than jump in greedily now and then regret again.
Right. So be wise in terms of your investment decisions. Don't jump the gun. Take your time. Make that list. Sit on it for some time and then start investing. Ajay Bagga, always a pleasure chatting with you. Thank you so much for joining us and giving us that perspective. Ajay Bagga there. Very interesting and pertinent points, Neeraj, that he made. I just want to also take a look at the mid-cap index. And this is what we saw for mid-caps in 2008, 2009. The carnage was a gradual thing which happened over a period of 1 year. It lost 68%. We've lost about 30% already in this downfall, but from the peak of 2018 for the mid-cap index, we've actually lost about 42%, which means that the rally that we saw in 2017, which took the index, the Nifty mid-cap index, all the way to its record highs, has been totally given back. So we've literally wiped off all the mid-cap gains that we had in the rally of 2017. And a quick glance, these are the futures, US futures, the Dow Jones Mini, which is still trading at lower circuit. There's no trading happening here, and S&P 500 Mini as well, where there is circuit trading that's happening. But I guess that's where we leave it. The last 1 hour of trade is going to be extremely important. We'll come back at 2:30 with live program.
Yeah, with the top global and local opinion both. Thanks so much for tuning in.
According to a recent report,